Welcome to Daily Rates Live with the Mortgage Calculator. Today, we're going to go through some live mortgage rates, and then we're going to talk about first-time home buyer loans. We'll get into that here in just a minute, but we'll wait a little bit here to get started to let everybody have a chance to jump on and let us go live on all the different platforms. We are streaming this live on YouTube, Facebook, and LinkedIn, so thank you everybody for tuning in on all the different platforms. As you tune in, feel free to drop a comment there in the chat. And then as we go into our deep dive topic today as well, feel free to drop any questions you have. I see some comments are already coming in. I appreciate that. Good morning. We will get started here in just a moment. Hope everybody had a great weekend and is ready to get back into it today on this beautiful Monday. Thank you for the comments coming in. Adam, Melvin, appreciate it. As you tune in, keep dropping comments there. Thank you for everybody tuning in nice and early. And it looks like we are live on all the different platforms, so we can go ahead and get it started here. Now, as we go through, as you tune in, feel free to keep dropping comments and also drop any questions you have there in the chat as we go through our deep dive topic for today. Welcome, everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And what we do on this show every morning is go through the live mortgage rates for today for a few different programs. And then we do a deep dive into a different topic every day. Today's topic is going to be first-time home buyers. So definitely a good topic for all loan officers to know about. So our sales manager, Jose, with 28 years of experience, is going to go through a deep dive on first-time home buyers. But before we do that, we're going to do what we do every morning, which is pull up our pricing tool and go through the live mortgage rates for today. So, Nick, if you're ready, let's go ahead and pull up that pricing tool and see what the market is looking like this morning.
All right, switch my screen, and we will check it out. All right, this is our pricing tool for our team of mortgage professionals. This will show us the general rates and the APR for today. It is October 16th, Monday, and it is just after 11 a.m. So all of our general programs are live here. So we will get a couple scenarios going and check out the general rates and APR. If you'd like a full breakdown of all the fees that go into the APR and itemized loan estimate, please get with one of our team members. We have over 400 licensed loan officers in 24 states for primary homes. So to compare the different programs, we'll set up the same scenario to compare. 400,000 loan amount. We'll set the LTV to 80% loan, 20% down payment. And we'll have the computer find the lowest rate option we can have, since most people want to see the lowest options. And we're going to check out conforming conventional and then compare that with FHA and then go into our expanded guidelines, also known as non-QM. We always offer VA and USDA as well. VA is only for eligible vets and active service members. If you are eligible, we can quote it, no problem. Just let us know. And USDA is only for eligible properties. If you do happen to be looking in one of those areas, just let us know. We'll start with conforming conventional. We'll do a purchase, 30-year fixed standard loan, primary occupancy, single-family home, 1 unit, state of Florida, county of Miami-Dade. And for all the demos, we use an estimated FICO score of 760 for the credit and an estimated debt-to-income ratio of 40% here. So with these basic settings, as we do every day, let's check out the conventional options. Doesn't look much different than it did last week. Excuse me. Best option here for the APR, the computer found 7.25 rate, 2.125 discount points in cost, puts the APR at 7.454. So remember, the APR includes all the fees for the loan. So this allows us to compare different programs apples to apples. So if for any reason our customer doesn't qualify for a conforming conventional program, typically the next option we want to look at is an FHA. So we'll come back here, we'll set everything up exactly the same, and this time we'll choose FHA. Everything else is going to be exactly the same, even though FHA does allow a little more leniency on credit issues, as well as a much higher debt-to-income ratio. We're going to keep everything exactly the same so we can compare APRs apples to apples. And not much change from last week here. Best option at the top, 6.49 rate, 2.5 discount points in cost, puts the final APR at 7.133. So it's a touch cheaper than conventional in this case if our customer qualifies for both. So as it has been for the last pretty much this whole year since FHA changed their mortgage insurance requirements. And for our customers that must use FHA, it's definitely a good option. So definitely check out the FHA programs if you qualify for both. And if you must use FHA, there's still some great options here where they have lowered the mortgage insurance. Where we love to specialize at the Mortgage Calculator is if for any reason our customer can't qualify for FHA or conventional for any reason. Many other banks or lenders will have to deny that customer. But that's where we love to present our non-QM options under expanded guidelines, where we have over 5,000 additional loan programs we can use using alternative income. So everything else will stay the same. So we have the same scenario, except a new option pops up for non-QM, and that's our income option. So full doc is what we use for conventional and FHA. That's 2 years of tax returns, what most people are used to. So we'll typically choose non-QM to use one of these other options, our asset-related options, business bank statement options. The investor options are just for investment properties, so those aren't applicable here. Personal bank statement 12-month is the most popular program by far. That's the one we do the demo with. We have RSU, stated, VOE, 1099, P&L, no income CDFI. We did these all last week on our live rates, so check out last week's episodes if you want to check out any of these specific options. But for the demo, we always choose 12-month bank statement, and that's for our self-employed borrowers. Many times it's our self-employed borrowers. When they submit 2 years of tax returns, have various write-offs, and may have some trouble qualifying with the income they need or may not qualify at all. In this case, we'll solve that problem by using no tax returns at all, just their last 12 bank statements, to determine a debt-to-income ratio of 40% in this example, using no tax returns at all, just the cash in the bank statements. So many of our self-employed borrowers will qualify for double or triple the amount of income using this method and can therefore get the home they really want. So let's check out the bank statement options this morning. Ha! Obviously, this isn't legitimate. Wow. This portfolio is legitimate, though. So this is where we go into the portfolio options. These are special non-QM. So this is the same one that we'll talk about here in a second. 7.375 rate, 2.5 discount points of cost, final APR 7.492. Now, a ton of these options will have various ways to calculate income. Obviously, this is going to be the cheapest option. Some of these may allow us to calculate income in different methods, may allow us to have bankruptcies, foreclosures, other issues that would cause us to not qualify. So as we scroll down here, there's dozens of different options. Please get with our team to find the best ones that fit for your scenario. And obviously, this option is not applicable here. Would it be legal to charge $89,000? Now, before we go into Jose's first-time buyer examples, which are very traditional examples, we're going the opposite direction here. We always want to do some live rates for investors. We love to work with investors. That is our most popular programs right now. Most of our investors are still very active. So we'll set up the same scenario, 80% loan to value, 20% down payment, and this time for investment properties. And we'll check out the lowest rate, and we'll compare our options for conventional with our options for non-QM expanded guidelines. Remember, government programs do not work for investment properties. So FHA, VA, USDA are not applicable. So we'll start with conforming conventional. Keep everything else exactly the same. The only thing we've changed here is the occupancy to investment, so we can see what adjustments the conventional programs have added. All right, so this is again where we talk about the portfolio program. So for investment properties, conventional have added some pretty large loan level price adjustments to basically deter some investors from using these programs. So what we see here at the top is a portfolio program that uses the same methods as conventional, full doc, same tax returns, everything, except it's not an actual conventional Fannie Mae, Freddie Mac program. So this is one of our partners that offers a portfolio program with no loan level price adjustments, so the pricing is much superior. So in this case, we can offer 7.125 rate for 3.5 discount points and costs. And that puts our final APR at 7.375. Absolutely amazing. Now, our actual conventional options, because of the adjustments that have been added, that pushes the rate up for our true conventional program here. So the best option we have here, 7.875 rate, 4.5 discount points and costs. Is probably a little bit too much anyway. And a final APR of 8.158. So with the rates being a little bit crazy, like they have been the last few months, obviously very volatile and very high, conventional investments are typically becoming less and less feasible. If you guys watch this show, once we start getting over 4 points for the best options, it's usually not typically a legal or compliant option to offer. So definitely recommend anybody out there considering conventional. Definitely not very feasible probably today. However, we have some amazing new portfolio options to check out, which blow the true conventional out of the water here. So definitely recommend our investors that are willing to go full doc, check those out. Now for our investors that want other options for non-QM programs, we're going to do our final demo here for expanded guidelines, also known as non-QM. So for our investment property under non-QM, the most popular income option we're going to select is going to be our investor DSCR. And that's because it doesn't require any income or employment from our borrower. We simply use the estimated rental income from the property to determine a DSCR. It stands for debt service coverage ratio. If the estimated rents can cover the PITIA of the mortgage, aka the property cash flows monthly, that's a ratio of 1.0 or higher. The property does not cash flow monthly and the ratio is under 1.0, we still have options for that. For the demo though, we always put 1.5, which is the highest value that the pricing tool uses, so that we can see all the options pop up. And the final thing we need to select is a prepayment penalty. It is standard for 3 years on these non-QM investment properties, so that's what we always choose for our demo. We could select 0 if we wish. That will limit the amount of programs that show up and cost more. We could also select 5 years if we wish, which will again limit the amount of loan programs, but does save some money if our investor wants to do 5 years. 3 years is the most common, so that's what we use for our demo here. So let's check out the DSCR options today. All right. So again, most of our investors, when comparing a conventional or full doc to a DSCR, will typically choose a DSCR even if the pricing is much higher. Typically, DSCRs, a point or two higher on the rate. However, today and for the last few weeks, since conventional is crazy, we have 2 programs right now beating conventional. So this top one, 7.625 rate, 3.5 discount points and cost, puts the final APR at 7.775. Remember, all the conventional options for investment properties are well over 8 APR. So we have a DSCR that beats conventional. 100% of investors, I promise you, will use a DSCR program if it's cheaper. It's a no-brainer. It is easier, faster, quicker, more flexible, no income required. You can do 1, 2, 5, 10 DSCR loans at a time to refinance multiple properties, buy multiple properties, a ton of flexibility. And we even have another option here. The second option at 8.017 APR still beats conventional as well. Now, they don't beat that special portfolio product we have, but they beat conventional by a long shot here. So definitely recommend everybody check out the DSCR options. They are amazing right now, beating conventional. And then most of these other ones are even at close to the same price as conventional. Absolutely amazing. And if we scroll down here, some of these other options may allow bankruptcies, foreclosures. Some of these other options may allow short-term rental income, very popular request. Some of them may allow specialty properties, manufactured homes, mixed use. Tons of flexibility that comes in with our DSCR options. So please get with our team if you would like to check those out. And now we'll switch to our topic for today, which is very different than investors. These are our first-time homebuyer programs. So we always do the live pricing for investors, but obviously first-time homebuyer, we have some specialty programs. These are our true first-time homebuyers for primary homes. Obviously, we're not talking about first-time investors here. We're talking about the special first-time homebuyers for their first primary home. These are the people that have been, I would say, typically stuck for the last year or two, as the markets have been quite drastic and very difficult for your first-time buyer to qualify, especially using these specialty programs. Now, as the markets have cooled down a little bit, as far as the actual real estate, of course, the interest rates are not the best, but now with the market cooling down, definitely some great options to utilize these specialty programs as options are opening up, as inventory is opening up, as sellers are more willing and able to negotiate and accept some of these, what may be considered less favorable offers when you're a seller. So, challenge in the past for a lot of our first-time home buyers has been to get their offers accepted using these special programs. But again, with the market climate the way it is, these programs are even more viable. So definitely all of our loan officers out there, pay attention to these specialty little niche programs. And even like the DPA and stuff that can get added onto these specialty programs. It's definitely could be viable now where it may not have been in the future. So these are definitely moving up on our radar as great options for our borrowers as the markets expand a little bit in the flexibility there. So Jose, if you're ready, let's go ahead and explain a little bit of the ins and outs on these first-time home buyer programs. A lot of these don't require first-time home buyer too. That's what's confusing. So I hope you can make sure that that we get the confusion out here.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Great to be with you here this morning. So like Nick was mentioning, the first-time home buyer programs have been a little challenging, mainly because they are high LTV programs and challenging only in markets where you have low inventory and lots of competition for the listings, because unfortunately, when we do get multiple offers, the high LTV programs tend to not be given as much consideration as the lower LTV programs when you have multiple offers. So in some market, that is changing as we are getting back a little balance with demand. Unfortunately, as the rates have risen. So it does open up some additional opportunities for those borrowers that were waiting in the sidelines with their high LTV options. The first-time homebuyer program is one of the better options. We do have conventional first-time homebuyer programs, which is another benefit, as you know. When we do have multiple offer situations, there's also the consideration of FHA or conventionally financed offers. The conventional finance offers tend to have a little bit more preference than the FHA financed offers. Our options here, we are looking at Home Ready and Home Possible, as well as Home One options. The Home Ready and Home Possible options do have income restrictions. You usually have to be at 80% or less of the area median income as determined by HUD in order to qualify for Home Ready and Home Possible, unless the home is in a low to moderate income census tract, or unless it is in a minority census tract. Then the Home Ready and Home Possible income limitations are lifted. That is the good benefit of the Home One option. It is a Freddie Mac program that does not take into consideration area median income. So the rate is a little bit higher, but still great option for those borrowers looking for 97% LTV financing and for reduced interest rates.
And reduced MI, just touch on
yes.
that real quick. That was the one thing that all these programs have in common when we do qualify for these, correct? Reduced MI.
Yeah, the MI factor on these, normally the MI factor at a 97% LTV is going to be 0.35. In these cases, the MI factor is less than that. I believe it's 0.25. So it's quite a bit of a savings there. So first option, the other thing I did want to state is that these programs are for purchases and rate and term refinances only. No cash out refis are possible with these programs. And the Home One program is for one unit properties only. That's also a big situation there, because Home Possible and Home Ready are for 1 to 4 unit properties at the same LTV and cost. No loan level price adjustments for a 2, 3, or 4 unit property using Home Ready or Home Possible. So that's an amazing option for our house hackers out there. So in this rate sheet,
Can you zoom in a touch, Jose?
sure, I wanted to show you all some lender credits
Okay.
as well as points, because usually with these high LTV, low down payment borrowers, that makes all the difference. They usually are not going to have the resources to buy down the rate, so usually they're looking in the opposite direction. Is there any lender credit possible that could help with their situation? So here we do have 8.125 has a lender credit of 1.013, as you can see, and you can buy it down for those choosing to buy down the rate all the way to 6.875, and this is for a primary 1 unit property. Excuse me 1 second there. Yeah, that was our home rate option. Now our Home Possible option, let's compare the rates here a minute. Should be
They're almost identical, huh?
Yeah. Let me see here.
They look almost exactly identical.
Yeah, they are exactly identical. Okay. Now, one of the reasons why you're going to be considering one over the other is going to be with the property type. Because, for example, if you're looking at manufactured homes, Freddie is much more lenient with manufactured homes than Fannie. And another reason would be, again, student loans. Freddie and Fannie do analyze deferred payments on student loans differently. Fannie with 1% of the balance as the payment, Freddie with 0.5%, and also self-employed borrowers. So the reason really isn't going to be rate why you would choose one or the other. It's going to be guidelines, or also you have scenarios where you run it through Freddie, you get you get your accept, you run it through Fannie and you don't, or vice versa, because they are different underwriting algorithms. And now our Freddie Home One, not Home Run, it's close, Home One program for 97%. Now you will note rate is a little bit higher on this one. Here, let me put the credit amount there. If we're going to compare, let's see here. So this one gave us
you can actually buy it down lower, but the credits are not as much. So that's an interesting comparison.
1.03 there and 0.675.
But the buy downs are better. So it's an interesting sheet there.
Let me see what we're talking about here. So yeah, I see that.
So the lender credits are less, but the buy downs are actually cheaper, which is interesting. So yeah, things change daily too, guys. So these are the kind of things you want to watch out for as an MLO. As your customer is zeroing in on one of these programs, you might find a slightly better option one day than the other.
They're probably taking into consideration that in these programs, most buyers, at least in the Home Possible, Home Ready, may be looking for lender credits. I don't know, right? Could be interesting. Maybe they tailored the rate sheet to be able to help those looking for lender credits. So now for our 2 to 4 unit, wanted to show all of you that our costs are the same. No loan level price adjustments. Actually went a little bit higher here in the lender credit but this one is available on the other ones as well. 1.238 at 8.375, and you buy it down to 6.875. So that's our home ready option. Home possible, same. You got 8.375 with 1.238 lender credit, and then you can buy it down to 6.875. Now, as our last example, I just wanted to put something out there because technically this is not a first-time home buyer program, right? Everybody thinks down payment assistance of this type. Now, what I will say is with the Home Possible and Home Ready, as well as the Home One, well, it's a tongue twister, Home One option, they do allow you to combine with community seconds up to 105% total LTV. And most of the investors that we have for these programs do allow combining with a community second. You just have to let them know at loan submission what's going to happen there. Now, first-time home buyer programs, DPA is not a first-time home buyer program, like I was mentioned. It's basically an FHA program, which works in conjunction with a national down payment assistance option. So this one here I'm quoting is the repayable option, which is the one with the best pricing that does actually have something that you would say resemble lender paid pricing, because in this case here, this is full comp, lender paid price on this deal, where the borrower is paying 0.235 in loan discount to get 8.25% rate. So with this option, you do get your DPA, which is in the form of a second mortgage at a 9.99% interest rate, equal to 3.5% of the sales price. So that is can go towards whatever down payment assistance, closing cost assistance. Essentially, it goes towards your funds to close to offset 3.5% of the purchase price of your cost. So in this case, we'd be looking at $17,500 in closing costs or down payment assistance, whichever way you want to look at it. So again, I put this there because typically this is something that the first-time home buyers will be requesting. This is not an option that requires you to be a first-time home buyer, but I wanted to put it out there because it is one in high demand by first-time home buyers.
All right. It looks like we do have a few questions here that we could get into.
So Michael has a good question here. They're going to increase the LTVs, but they have not released the loan level price adjustments that will be applicable. But the lower MI, if you use a home ready, will already still be applicable. So little confusing there. The lower MI, the reduced MI, is on the special programs. That's not related to necessarily the announcement that you're referring to, where they will allow higher LTVs on 2 to 4 units. There will be adjustments, I promise you. It's going to be expensive, I bet, right, Jose? On the standard 2 to 4 getting updated to 95 LTV. But I haven't seen those adjustments yet, so that will be interesting.
Yeah, the Fannie Mae changes are for regular loans, not for first-time home buyer loans. So that's, like Nick was mentioning, totally unrelated to what we're going over here, which actually allows 97% LTV on 1 to 4 unit properties. There's no loan level price adjustments.
So these already have the expanded things that you're talking about there, Michael, is what Jose is saying. So in his example, we did do a multi-unit one, and they do allow higher LTVs on these special ones only, though, right? Now their whole matrix will allow higher LTVs on multi-units. So good question, though. A lot of people are having the questions about what's going to happen. once those pricings come out, we'll be checking them out. The new loan level limits too are released. We have 3 or 4 options that will allow you to exceed the limit already, and then in the coming month, everybody will start doing that as well. We had a question from Kyle. That's more so from an insider question here for pricing. So you can contact us for some pricing information there, Kyle. Our emails are listed by our names here.
All right. Okay, cool. Well, I guess we can go ahead and wrap it up then. Thank you, everybody, for tuning in. Remember, we do this 11 a.m. Eastern every weekday where we go through the live rates and then do a deep dive into a different topic. So we'll have a new topic tomorrow. Thank you for the questions as well. Appreciate that. Thank you for tuning in. Thank you, Nick. Thank you, Jose. And we will see you all tomorrow, 11 a.m. Eastern, for the next episode of Daily Rates Live with the Mortgage Calculator. Have a great day, everyone.
Thanks, everybody.
Thank you, everybody.